Hey everybody, welcome back. Tonight we're going to cover the S&P. We need to talk about what the heck happened at 2 o'clock, why the market dropped the way that it did, why certain names are breaking out the way that they are. It's very specific which names are breaking out. We need to cover why that is. Hearing a lot of talk about the breadth, I want to show you why that's kind of a misnomer, how we can actually use the breadth to our advantage, and then show you strategies that are actually working for us in trading right now. So let's just jump into the basics. First and foremost, you can just see that we made the higher high. Let's get rid of this line and just talk about it. So you have two dojis up here. We know dojis are signs of uncertainty. The S&P coiled, broke out, ripped, and that's the end of it. Now, let's just remind ourselves of this date right in here around the 16th, 17th, 18th, and 19th. That's going to be important in about a minute here. But you can see how we're forming that bar. We break out, push, the retest, and then go. Now, the majority of people are saying, okay, well, the breadth is bad. This is bad, and we're getting frothy. There are frothy signs, 100%, but there are ways of determining when that froth is coming to a head. Not the exact day, but you'll see it, and you're not going to know intraday, but I'm going to walk you through this. A lot of questions about the skew and trading around core positions in the comments. I'm going to cover those in great detail. So let's get into it. First and foremost, I want to start here. Let's drop into a 1-minute chart. And I'm going to clean this whole thing off and just go right here and take a look. This is what we dealt with for the day. Now, we do have off tomorrow. And why some people enjoy the holiday, I myself kind of go batty, climbing the walls, waiting for the next day where the market is open. But that's me. I have issues. If you see how this is playing out, you're kind of wedged in there, aren't you? Right? And so you've been wedged in there for a little over a day, and you really didn't go anywhere today, and that's not the most important thing, right? But there was something that was pretty important today that I think we should talk about. So we watched the 18th, and we're watching this play out. Now, what happens in here is you see that little move at 8:30. Now watch this move at 8:30, and I want to show you this because this can change your trading. So you're going to want to watch this part because I'm going to say it again. If you understand this, it can really change your trading. The 8:30 move that happens on that date, right? When you see that 8:30 move on retail sales, you can watch it on Thursday, you can watch it on CPI, you mark them off. This is really important. A lot of people already know this that watch these videos. You always mark those areas off because you want to see how you respond in those areas. Because that first bar is really where the algorithms are going to be playing. And if you look during the day, that became resistance at one point. And then at the end of the day, what did it become? It became support. So what is that telling us about the algorithms and high frequency traders that mark that level? It's telling you at the end of the day, what did they do? They bought. So what you're doing with this is you're not only utilizing this during the day, and they might just tear through it like tissue paper, but if you ever see this at the end of the day where all of a sudden they look like they're flipping, you just might want to pay attention for that for the next day. That's the first thing that I want you to take away from this chart. You might want to watch that part of this again. The second way to look at a 1-minute ES and see what's going on, see these drops that are here at 2 o'clock? Yes, they're important. How about what happened at 1 o'clock? What happened at 1 o'clock today? Well, if you've been watching these videos for any time, you know one thing. We watch the bond auctions. We watch the bond auctions because we want to see what they're doing. Are they buying bonds? Are they not buying bonds? And we're going to get into what happened here at 2 o'clock. We're going to get into it in some detail. And the volatility you're seeing and why people don't understand it. But you see this move to the downside? This is what you call a false move. Now, people will say, well, how do you know that's a false move? And I'm going to show you how you can determine that this is a false move and then how you can use this in your own trading. So you break down and you think, okay, the bond auction didn't go well because clearly we're selling down, the market rallies, and then you look at that area by the end of the day and you're back to all-time highs. Well, why did it do this? This is called a false move. And the easiest way to determine this is to look at a very simple chart. And the chart that I always pull out is just the TNX chart, TNX, SPY, and then also you have the S&P in there. I'm just going to go to it real quick, pull it out instead of creating it, which probably would have been easier to just create it. And then we'll just go here and we'll turn this into a line as well. Now what I'll do here is we'll click off this SPY so you just have those in there. And what you're going to see is the ES and the dollar come in here. And then you're just going to go TNX and drop that down. That's going to be the yield. Now, once the yield's in here and you have all three, I'm going to clean all my notes off. And what you're going to do is you're just going to mark this off from the 1 o'clock level. And you're going to see that move on the 1 o'clock. And what happens here to the yield? The yield plummets at 1 o'clock. Absolutely plummets. So they're buying bonds. And then it reverts, but never gets back over that 1 o'clock. And then what happens from there? The ES does what? Starts lifting and going from there. And meanwhile, the dollar I have always as a guide, but the dollar is a secondary indicator in this case. And the dollar continued to push higher, which is rare, but it's a secondary indicator. But I do put it in there in case I'm at a coin toss. This would have saved you an inordinate amount of money today using something as simplistic as this, because you see how they move us down? All we did today was watch. And we watched and we waited so we could get the real move. Now, I always like to put these out so that people can see that this is actually what we're doing. We're just not talking about it. But in the community, I'm actually typing out bond auction was good. The SPY sell-off looks like nonsense. Flim flam, they're buying treasuries. Always watch the bond market. You don't need to watch the SPY. The bond market's not going to lie. The SPY is going to lie. And so the bond market moves down. ES moves higher. So you want to buy that dip. Now, if you're doing that, you're like, well, I don't trade the SPY. I don't trade the bond market. It doesn't matter, right? All that matters is that you know that they're doing that, because it doesn't matter the name of the stock when it happens. For example, if you're trading NVIDIA, or if you were trading Dell today or ARM, it doesn't really matter. You're going to see the same kind of nonsense around that time frame all the same time, because they're just going to move them all the same way. Go to 1 o'clock, drop a line, and you're going to see that little decrease in these names. Well, Dell fell apart, but you can see that little move down, and then they start lifting and doing whatever they're going to do, right? That's a very important distinction, and you can benefit greatly from it. So you just might want to remember that the next time you have a bond auction, specifically the larger long-term bond auctions like the 10, the 20, and the 30, they tend to be more specific with that. But let's get into the breadth. Now, in front of you is a chart that I created, and it's a very simple chart. People say that, they want me to share these. I'm figuring that out, how to put them out as script and to share them on TradingView. And if you have a way for me to do it that's simple, that I can share them on there so people can just grab them, just let me know. I have no problem sharing anything that I show here. Someone actually made fun of me the other day with the RSI. Are you ever going to give because my measurements are different and people notice. All you have to do is ask. I have no problem sharing stuff. So if you look here, and what you'll see is 3-month low up here. But all these are lows on the New York Stock Exchange. And what I do is I just put them out there to see if they're all going in tandem. But there'll be the 1 month, the 5-day, the 1 year, the 52-week, the year-to-date. And they're all these lows. Now, what this does is I'm always looking for anomalies. Because what I will always find is people will talk about, oh, the breadth is bad, stocks are hitting new lows. I got to be honest, I don't care. And the reason I don't care is because they're using this wrong. So the way that they're using it is like, oh, because you're doing this, then therefore the market's going to come in. What I take it as is the market is currently weak. So even though the market is going up, it's currently weak, the breadth underneath of it. But if the breadth gets better, what's going to happen to the market? Well, the market's going to get better. And remember earlier I said, hey, you want to watch a very specific period of time, take a look at April and watch what happened in April. And then you can see from April 16th on, they started buying and we started getting better all across the board on all the new lows from the New York Stock Exchange. And then all we keep hearing about is how bad the breadth is on Monday, and it's so bad. You see how it's starting to turn around. And you just kind of look at these dates, and you just maybe we look at that one too, the 29th, and see if there's anything there on May 29th. Frankly, I don't remember if there is or not. But you always go and take a look at that and go, all right, well, what happened? Pardon my voice. And go, okay, well, a couple of days later, that was the bottom of the market. But there were other signs that was coming too. And we'll get to that in a moment. But then you go to the 29th. Yeah, and there you go. Okay, so there's another one. Well, that's the 31st. It was a couple of days over here, and then you bottomed out, and then you hit. And now you're starting to turn again right now, and the market's at highs. So is this a sign that I need to get out of the market, or is this a sign that we're about to go higher? Right? So I'll say it again. Is that a sign that you should be getting out of the market, or is this a sign that you're about to go higher? So if the breadth is awful and the breadth gets better, is the market going to go up or down? Well, the market's going to go up if they buy more names, right? You don't really need me for that. You could have saved yourself, 30 seconds there. But if you look at this and you watch how this is playing out, these are demarcations on when we actually saw turns and the breadth gets better. Doesn't it make sense that if the breadth gets better, then the market in and of itself is probably going to get better underneath? That kind of makes sense, right? And you can see this by other variables, and we'll get to those in a second. But what I would argue is I'd want to see if we make a higher high on this. So what I would mark is something like this on TradingView, where I would go here and then I'd want to mark that off. Let me get rid of this magnet. But what I would do here to get value is I'd put this here, and then I might just go up here and put an alert and say, hey, if this goes off and you come back up here, just let me know, because I don't want to be breaking out and making higher highs. That's not going to be groovy if that happens, but I want to know if it does, right? Just like here, if I thought that there might be a problem and I see a peak and then another peak and another peak, well, maybe I do have a problem here because we are hitting higher highs, right? So I don't, again, want to tell the market what it's going to do. I just want to act when I see it. So in other words, if I mark this peak and this happened, I'd be like, oh, I might have an issue. The market is getting better. The breath is getting worse. See, we're not telling the market what it's going to do on any of this, are we? We're just letting the market do whatever it's going to do, and we just make money off of it. It's a heck of a lot easier than tying your ego to it and the hubris that comes with that. So again, what are we doing? We're watching the breath and we're making good decisions, right? Like I tell my son, make good choices. So if you go through just the breadth of the market, and we'll look at the S&P for a second, look at the 5-day. Is there anything really wrong with the S&P 5-day moving average? You're at a 52. So there must be something wrong with the 50-day. No, you're at that 45. Would I like to be at 50 or better? Yes, I would. I don't want to be under 50, but I am. And this is the hand that we're dealt. So the 200-day, they must be getting smoked. No, 66%, 65.6% of them are above their 200-day moving average. Okay, well, it must be the 20-day. Now, 40% of those are still above. Okay, and we washed out and hit a new low, came up to a new high, and now we're in the middle. So when we talk about the breadth, and we talk about the breadth being a problem, and only these stocks are making the moves and only these names are moving, maybe people are just in the wrong names. And maybe they should be worried about their stock selection, because I'm having no problem figuring out what the trends are. And this is what's so important about the way that we look at the market, right? And when I say we, how I was trained to look at the market, it was always this. There was always index. Okay, this would be better and way cooler without that magnet. So I always look at it and go index, right? And then I go from there, then I go sector, and then I go stock. But I'm always looking for themes. And you have two really good themes right now, and they are AI related. One is business, one is consumer. Okay, and that is why ARM's doing what it's doing. That's why ARM is lifting off and like it's ready to, like a rocket ship right here. And people knew that this was coming, and you could see that after earnings. We can get into this later and what to do with it now, but that's why ARM's doing what it's doing. It's why Qualcomm's doing what it's doing, okay? That's why Apple's doing what it's doing. That's one AI theme that's going to be around. To build all that out, you're going to have to look at the KLACs and understand why Wells Fargo did what it did today and blanketed all the semiconductors. So if we look at the semiconductors, do we have a problem with the names that are going up? I don't have a problem. I don't have a problem with breadth. Go and take a look at semiconductor capital equipment manufacturers and tell me if you have breadth. So maybe people are just in the wrong names. And again, here's 29 names. If I go through that list of names and I move it over, and I'll show you for a second here, but what you'll see with them is how many of these were down versus how many of them were up. Okay, so all right, some of them are down, some of them are up, but it's more than what people are suggesting is going on. So here's where I want you to go with this. And this is where really important part. Stop listening to what people are saying and start doing your own work. Okay, because if you go on Twitter and you listen to people and you're going to go batty. I watched somebody talk about the short squeeze that the cat guy was going to do on GME. Where's my squeeze? Didn't happen. Okay, because they don't know what they're talking about. Do your own research and learn how to do your own research so you don't have to rely on anybody. The whole purpose of these videos is so that you can learn how to do this stuff yourself and inform yourself and educate yourself and take what I do and then build on it, right? And all of that starts here. It starts with index, and then it's sector, and then it's stock. And by doing that, you'll find themes. That's how you found the AI theme. That's how you knew to buy NVIDIA and not how to buy, not to buy AMD, because it's a disaster. It's a dumpster fire. We all know that now, right? So when you start to understand this stuff, you can start connecting the dots. I'm going to need more widget makers to make more widgets. That just makes sense. Connect the dots, and it'll put you in front of the right names. We're going to get to names in a moment, like NVIDIA and why NVIDIA is going to continue to move higher. I actually added to the long-term position today, and I want to go through a concept, but there's a litany of stuff that's going on. That's the technical term for it, stuff, that I need to go over with you so that you're prepared. Give me a second. Now, thank you again for your comments. It does help me greatly in trying to inform and educate, and it's not my forte. So I appreciate everything that you guys do, because if you have an issue with it, that means someone else has an issue with it. And I want to get that out there. So I do appreciate it. I wanted to show this in form so that you can see what happened. 1 o'clock hits, the 20-year does what it does. U.S. Treasury bond yield was 4.47% on Tuesday, 18th. Over-the-counter inner yield quotes for the government maturity historically. 20-year bond reached an all-time high of 6.12 in 2023. Wow. 6% somebody locked in. Isn't that crazy? Anyway, this is what happened. Then the CBO comes out. Okay. Now, this is important because this tells us what's going on with the federal budget. And it's really important for you to get that. It's pretty significant. Now, I'm showing this specifically because you can see what happened when the market dropped at 2 o'clock, and we're going to tie this whole thing together. Okay. And I'm not showing this for political reasons. And quite frankly, I don't want to hear it in the comments. There's plenty of political channels you can go to. I don't care what side of the aisle you're on, red, green, right? Or what do they call it? Red, blue. I'm on green. That's it. So if you look here, 2 trillion red ink. So what they're saying is 2 trillion in red ink. And this is the worst it's ever been, right? And the reasons for it are foreign aid, Biden student loan policies, hike U.S. deficit forecast. So this is bad. And that this gives us this budget gap of 400 billion. And then where does that come from? And then you're running this deficit. Once this hit from the Congressional Budget Office, CBO, and this is pretty much a non-bipartisan office. They're like, look, these are the numbers, right? And it is what it is. And they'll come out and say, like, this is why, the student loan relief policy, and whether or not you think you should be paying for someone getting a basket weaving degree or not, I don't really care, right? But this is the issue, and this is what we have to deal with. So when we look at this stuff, you have to understand why we dropped at 2 o'clock and then what's going to move us forward. This is the issue. Now I'm going to tie it all together, but understand why the market dropped at 2 o'clock and the significance of this. Now, TLT pushed higher nonetheless and was bought and closed at the high of the day despite that. And that's the part that you need to take from this to begin with. It blew it off, okay? And if you look at the 1 o'clock level, really important to get this, they bought. And that buyer never went away. All right, so this is really important to get. Despite that headline, there's your buyer at 1 o'clock off the auction. Here we are at what? 2:30, Dennis' favorite time of day. They're still buying, right? They're still buying there. And where's that take you? Back to the high of that bar. You're going to want to watch the high of that bar on Thursday. You might want to mark it. You might want to go like this and just drop a little line here and see if the non-farm or the initial jobless claims, if it moves us over. Why? Because do I still have a seller at the 1 o'clock level even after the 2 p.m. CBO data was released? If the answer is no, then they believe. Understand this. The bond market moves us. They don't play games. Okay, there's not like the futures algos. They're not doing that with treasuries. You can't do that unless you have trillions. They don't have trillions. So this is about as clean and a moving market as you can get. Now, there are some things out there that are really in our favor domestically that we should point at. So we have a strong bond market despite the deficit, and we had a strong bond market before the deficit, and we had money going to equities. This is the part that I think people are missing more than anything. I don't think they're getting that. So this is Sediment Trader right down here. It's not mine. And I just want to bring this to everyone's attention. This is showing you the world indexes. And what this is showing you is the all country breadth, and it's showing you where you are on a percentage basis above the 50-day moving average on a percentage basis. Just like the other percentages we went over. You've gone from 70 to 25 in 5 days. It's a dumpster fire. It's an absolute dumpster fire. And this is really with what's going on in France. So what's happening and what's moving our markets and making our markets more attractive, if you could believe that, I'm trying not to laugh, is the political stability of the US right now versus what's going on in Europe and what's happening in France, what's happening overseas. There's a lot of uncertainty. So they just puked names out. And we saw this with what's going on in Mexico. We saw this with what's going on in France. We saw this with what's going on in India. People just puke these names out. Now, India rebounded nicely, but this is driving money domestically into the S&P. Now, once that was released, the other data that I showed you at 2 o'clock, this comes out today, and I believe this was put out by Goldman. And this is what people are concerned about higher for longer. So what they're saying is the higher for longer could start hurting retail. And the higher for longer would be because if you have a deficit, then it's going to be really hard to curb inflation, right? You should be able to follow that. If you can't, just drop a comment. I can go over it on Saturday. Revolving credit as a percentage of disposable personal income. Revolving credit cards, percent of your disposable income. How much extra do you have? What percentage are you at? And you're back to that 6.5%, 7%. Well, you haven't been there since before the pandemic. And this is what they're predicting is where we're heading. Dotted lines extrapolates growth pace from the last 12 months. So if you take what happened over the past 12 months, this is what's going to happen. The delinquencies are going to become a problem because people are going to run out of money if they can't cut. And we've talked about this in the past. They're kicking the can down the line. But this could affect certain retail names later. This came out after 2 o'clock today. It did not really seem to have an effect, or did it? Well, I think it had a little bit of effect, and I'll show you why. At 2 o'clock, Amazon was straight down. Now, you have Amazon that was straight down from 2, and then you come here and you look at what happened right around here at 2 o'clock in regards to Walmart. You never came back. So are we seeing some of the big box names take it on the chin here? Is this going to be a problem? And I do think that we should be watching this pretty closely to that 2 o'clock level. Now, it wasn't all of them. This one hardly moved. Let's take a look at Costco because candidly, I didn't really look. I own that for long term. I really haven't paid attention. Yeah, but you fell off a cliff at 2 o'clock. So what Goldman's doing is they're tying this, please pay attention to this part of it, they're tying that CBO budget to the fact that delinquencies are going to stay higher and they're going to surpass in the next 12 months, which means people are going to spend less money, which is going to affect the big box names. Okay, now we're going to bring it all back and we're going to bring it all home. So the skew chart, I keep getting asked about this. The SPX 3-month skew minus this versus this. Listen, this is really simple to wrap your head around. And all I'm going to do with this graph is explain one thing to you. Are we tightening right now? Yes or no? And the answer would be no. Are we going into a policy that's going to eventually ease? Yes. The EU is going to ease. Canada's already eased. I believe EU eased once already. What that means to us is that we're going to go through a green period where the Fed is going to ease. They're going to incentivize us to buy long assets. And as they're incentivizing people to buy long assets as they ease, why does that incentivize us? Because the yield drops. Therefore, you're incentivized to buy long assets and take risk. You want to protect your money. How do you protect your money? You buy puts. Fed eases, you go through a period where you're going to want puts to protect yourself. That's the green. You were in the red. You're going from red to green. You're going from tightening to easing, and that is the skew that is changing. What is playing with everybody is the level of volatility because they're not used to it. Stay with me. So if we know point blank that we have issues, which we have issues, right? Okay, we're all aware of that. Then we can look at that and we go, the volatility is going to increase. And we all know the volatility is going to increase. And then we look at this, and this is how we're going to tie it to position trading and how to trade in this market. S&P trading sessions with since 2.5% or more one-day sell-off. You've had 376 sessions since greater than 2% sell-off, 2.05. Why that? I have no idea. You haven't had a sell-off like this. You have not had trading sessions since 2.05 or more one-day sell-offs. You're due. And then you look at this and go, well, this is 23 to 09. That's pretty far back. And then the last one was here, right? And so they're telling you where it is. Now, watch. Look how far back you have to go to see this. You have to go all the way back to 79, 80, 95, and then you'd get into here, which you have. It's pretty crazy when you start looking at this. So if we know that we're going to have more volatility, if we know that it's coming, and we're looking at something like this, it goes back to 28, and this is our demarcation line. This is pretty significant stuff, and this is certainly stuff that we need to pay attention to. So we have an environment where we know it's going to be more volatile. And we know that people are not used to it being more volatile, right? That's what that's showing. We know it's going to be more volatile, and we know they're not used to it. So this is a concept that works for me, and it's worked for me for a period of time. And it's a concept that I think will work for you, or something that you could implement. You have a position, and when you have a position, you refer to that position as your total position. So let's say that you own NVIDIA, and for lack of a better term, you bought 100 shares of NVIDIA here on earnings. And what you're saying to yourself is, I didn't really want to buy it because it's too high and the market's getting more volatile because the skew's changing. What do I do? You buy 100 shares and then you pick a percentage of that, and that is your non-core position. The other percentage is your core position. So if you bought 100 shares, to make the math simple, 50 shares is your core position, meaning that does not move. The other 50 shares you trade, and you trade around. Now, you can do a core position on a daily chart, a weekly chart, a minute chart. It doesn't matter. But the idea is I'm going to allow this to play out. For example, take a look at ARM today. This would be a great example of one. So if you bought ARM today and you know, like, wow, we're all over the place, but you bought ARM and then it trades up and you're like, I want to day trade this, but you think that it could keep going. You got to some key levels, you held them. You can see the break right here, 1230, and then the push after the bond market. Let's just say you bought here. And then you're like, okay, I bought 100 shares here and it trades up. And you sell into that a portion, and then it sets back up, you can re-add that position knowing that that is a trading position. So your full position has two parts. It has, as I refer to it, the core position, and then we can refer to the other part of that as the trading position, and that would make your whole position. Okay, so the whole position is combined of two parts, a core position and a trading position. What this allows you to do is flexibility. Because what people will do in volatile markets like this is they'll put themselves in the wrong spot. They'll put themselves in the spot of, I'm going to sell it all. And then I knew I was smart. I'm so smart. And then it rips. And then they buy it back and then they get stopped out and then they lose the profit they had here. Instead of doing that, because this market is going to be extremely volatile, as I think I've laid out pretty clearly at this point. So for example, like in the video, I have a position. I have different core positions over different time frames, like long-term core positions, long-term full position, right? Swing trade core, swing trade trading position, day trading core that I want to hold for the day and I'll get stopped out, right? And you just move the stops up. I can get more into this, but the idea behind this and what you want to wrap your head around is you don't know when these are going to pull back, but there's a pullback coming. And if you don't take that from this video, take it now. There's a pullback coming. We'll get more into it in Saturday's video or Thursday's video, but it's coming. What we want to do in looking at this is we want to make the best informed decision that we can, but we're never going to call the tops and we're never going to call the bottoms. The issue with a market like this is you don't know when it's coming. And so if you're trading the names of Clack or you're trading Nvidia or you're trading a Micron right now, and you're looking at this going, oh, well, clearly that's the high. And you're saying that when it happened here and now you're up another $20, you're going to miss the runs. So the premise is core position, trading position makes a full position, and you go from there. You don't need, here's a great example of this. I did this today where I have a core swing trade position in SMCI. And when it traded up into this, I sold a portion here, I sold a portion there. I don't need it to be below the other where I'm getting back in. I can just get back in. So for example, once it pulled back and retested right here, we could see it, the retest. So all I did was allow it to retest and get back over, and then I added to it, and then I can trade that position out like it's another trading position while I'm holding the core swing trading position, lock that in and leave the rest on in case I'm wrong, and then figure out and just buy it again, wash, rinse, repeat. I hope that makes sense. I can get more into this, but it's a great concept for a volatile market. That's it.